Welcome to Chapter 7. In this chapter we're going to consider how to account for overhead costs. This is a really important chapter in your studies as it covers lots of different issues that could arise in the exam in relation to the accounting for overheads. What we're going to look at in this chapter is the treatment of fixed overheads under both absorption costing and marginal costing principles. And this is one of the most important areas that you'll cover in your management accounting studies. What I would strongly recommend that you do with this chapter is take your time as you work through it, work your way slowly through the chapter, working through each lecture example and making sure that you understand each of the techniques before you move on to the next chapter. The next chapter very much builds on the knowledge that we'll see here in Chapter 7, Accounting for Overheads, so therefore it's important that you fully understand the principles behind absorption and marginal costing.
We're going to tackle absorption costing first because it's the most complicated of the two methods and it's also the one that's required in published accounts. So with absorption costing, what we're aiming to do is to allocate overheads to units to find the full production cost. So the cost of producing a unit which includes the fixed overheads. And we've got a three-step approach to doing this. We'll start off then with allocation and apportionment of overheads, reapportionment of service centre overheads, and finally absorbing an amount of fixed overheads into individual units of production so that we can work out that total production cost and complete our absorption costing cost card. We're going to tackle these steps in this chapter once we've understood the basics of absorption costing and why it would be useful. So we've said before then in the course that businesses need to know how much it costs to make a product or service so that they can work out how profitable that product will be if they know what the costs are, so that they can set a selling price, and profitability and selling price very closely interlinked, but also to value inventory. And per the standards, inventory must be valued at its absorption cost, at its total production cost. A way of summarising the total cost of producing one unit then is via a cost card. And referring back to some of the terminology that we saw earlier on, the total then of all of our direct costs is the prime cost. So that's the direct materials, direct labour and direct expenses. But in order to get to that total production cost, we're going to need to add in some overheads. And this chapter is concerned with how under absorption costing we can take our overheads and work out an amount per unit. So a production overhead then is those costs which are incurred as a result of production but can't be traced directly to the product or service, and so we sometimes refer to them as indirect costs. Now, these are just production overheads that we're looking to allocate to units, and you remember from Chapter 3 that a production overhead are the overheads that exist because we have a factory. Worked example 1 then just classifies some examples of the different indirect costs. So indirect materials then could be things like oil and grease for the machine or paper towels that are used on the production process. Indirect labour could be a supervisor, and the biggest category is usually the indirect expenses. So these will be all of the costs associated with running the factory, for example, rent, rates, insurance and depreciation. Working out the prime cost then is usually quite straightforward because you can say, well, if we're producing a table, we need the wood, we need the glues, we need the screws. But because the overheads then are not particularly attributed to one unit, what we need is a way then of sharing out the total production overheads to each cost unit. Now, if we had, say, overheads of £1 million and we were producing 500,000 units, then it would be quite straightforward to say that the overhead per unit should be £2 per unit. That's very simplistic if we've just got one type of overhead and one production unit. But that's the basic premise of what we're doing, as we're sharing out the overheads between the number of units. What we're going to see now then is that we have to work out how to get to that 1 million and how to get to the 0.5 million. So we're going to work through a diagram in section 2 of the absorption costing steps. So remember, what our objective is to work out the full production cost of producing a unit, and that includes an element of the overheads. The total production costs then are the costs that exist because we have a factory, not because we have a business. So these are all of the costs associated with production. The first thing then is quite straightforward. We can take our direct costs and we can pop them into our cost card, because if we're making a table, we'd know how much wood we were going to be using. When it comes back though to our indirect overhead, it's more difficult, and so we're going to use a 3-step methodology. And step 1 then is to allocate and apportion all of our overheads into the different cost centres. Remember, a cost centre then is anywhere which we want to collect expenditure for. And what you'll notice then is that we could have production cost centres, but we could also have non-production or service cost centres. And those are cost centres through which units of production do not flow. So an example of a service centre might be a canteen. What we need to do then is, in step 2, we need to reapportion our service centre overheads so that we just end up with an element of fixed overheads in the production cost centres of the business. And that is so we can then use the final step, which is to allocate fixed overheads for each of the production centres into the cost card. So we're going to end up with a fixed overhead charge for production department 1 and a fixed overhead charge for production department 2 as our indirect costs, which will be added to the prime costs to give us the full production cost per unit. Now, in your exam, you're not going to have to do all of the steps in one question, but you could be required to do any part of any of the steps. So what we're going to do is we're going to work through looking at the processes involved for each of the 3 steps. And in the case of step 2, the reapportionment of service centre overheads, we'll see that there are alternative methods that we can use to get those expenditures from service cost centres into production cost centres. But it's useful to keep coming back to this diagram to remind ourselves of what we're doing. So we start off then with step 1, getting all of our overheads into the cost centres. Then we want to get overheads only into production cost centres so that we can absorb those overheads based on usage of the resources per product into the costs card. We start off with step 1 then for allocation and apportionment of production overheads. So when do we allocate and when do we apportion? Well, we allocate if it's going to be the whole item. So for example, the chef's wages then would be entirely allocated to the canteen cost centre. We'll need to apportion some overheads then when they're shared out between the different production and non-production cost centres. So for example, rent, we might need to share that out amongst different departments based on perhaps floor area. And you'll be given information which will help you decide the most appropriate basis to apportion the information in the question. Lecture example 1 then is going to take us through step 1 of allocating and apportioning our overheads to different cost centres. So what you can see then is we've got $262,000 of overheads to be allocated and apportioned, and they're split into 4 different categories of overheads. You can also see then that we've got 4 departments here, 4 different cost centres. We've got mixing and stirring, which are going to be production cost centres, and then we've got stores and canteen, which are non-production or support cost centres within the organisation. And we're given some additional information about each of those departments, which will help us to allocate and apportion the overheads given above. And what we have to do then is to work out what the total cost should be in each of the departments. And we're going to do it for each of the departments for completeness, but in the exam I would expect that you would do it for one department. But the method would be exactly the same. So the easiest way to do this then is to set up a table with the headings of the 4 departments across the top. The first part of this then is to allocate any overheads which can go directly to one department. And you can see here then that we've got $75,000 of stores costs, so all of that is going to go into the stores department. So $75,000 will go into the stores department. The other costs then need to be apportioned, so we need to think about the most appropriate basis for that apportionment. So if we're thinking then about rent and rates, an appropriate basis of apportionment might be the floor space. We're given the information then about how the 15,000 square metres of factory is shared out between the departments, and as the mixing department has the most floor space, is the biggest department, it seems appropriate that it should have the most amount of rent apportioned to it. The insurance costs of the machinery could be based on the net book value of the machinery and the equipment, that information that we're given below. The stores case we've already dealt with, we've allocated that to stores. And then finally we've got the heating costs. Sometimes you might do heating costs on volume, but we don't have information about the volume, so we need to make the best use of the information that we've got. So again, we could do that on the basis of floor area. So what we're going to do now then is allocate, apportion those costs to the different departments. The rent and rates then are going to be allocated on the basis of floor area. 9,000 is going to be allocated to mixing. 3,000 square metres is the stirring department, 1,000 the stores, and 2,000 the canteen. So what we've got then is 15,000 in total. And our total costs then for the rent and rates are $90,000. And so what we're going to say is that 9/15 will be the mixing department. So $54,000 of cost will go to the mixing department because it has the biggest proportion of floor. So 60% then of the factory is the mixing department, so it will get 60% of the costs. We then do the same for each of the other departments. When you're first getting to grips with this, you might find it helpful to write down the proportions, but some people will be able to see it much easier depending on how confident you are with the maths. The exam isn't too time pressured, so you do have enough time to write down the workings and get it right rather than rushing through it. So for the stirring department we've got 18,000, for the stores department we have 6,000, and for the canteen we have 12,000. And that comes back to our 90,000. We now need to allocate the insurance costs, which are going to be done on the basis of the value of the machine. So we've got 20,000 of insurance costs to be allocated, and we'll do that on the net book value of the machine. And that's in the basis 2 to 1 to 0.6 to 0.4 million value of the machines. As 50% then of the value of the machines lies with the mixing department, 50% of the insurance cost is going to go into the mixing department. Half of that again will go to the stirring department. And then finally, the next cost to apportion then is that of insurance, and the insurance costs in total are 40,000. I'm going to split that out, as I said, on the basis of the net book value of the machinery. The machinery in the mixing department then is worth 2 million, in the stirring 1 million, in the stores department 0.6, and finally in the canteen 0.4. So we've got total machinery value of $4 million. So we've got 2/4 or 50% of the cost of the machinery is in the mixing department, so it will have $20,000 of insurance costs. In the stirring department then, we've got 1 million out of 4 million, or a quarter of the costs, so 10,000 to the stirring department. 0.6 out of 4 million is going to be 15%, so 15% times by 40,000 is 6,000, and the final 4,000 to the canteen. Finally then, we've got the heat and light costs, and the heat and light costs in total are 57,000. Now you may have noticed that these are going to be allocated on the same basis as the rent and rates, so we're going to use the same proportions here. If you wanted to, for speed in the exam, you could have combined the 90,000 and the 50,000 to only do one apportionment. And those kind of shortcuts will come with practice when you're more familiar with the material. So the 57,000 then will be split with 34,200 going to the mixing department, 11,400 to stirring, 3,800 to the stores, and 7,600 to the canteen. So that's how we've split out the 262,000. What we need to do now then is to total for each of the departments, and arithmetic accuracy is important here. Once you've completed casting the columns, you should notice then that we have the most overhead allocated to the mixing department, and followed by the stores, which is high because of the 75,000 directly allocated to it. It's important then that you cast these figures correctly in the exam, because you don't want to lose marks for your final arithmetic, so don't do it too quickly that you make mistakes. It's worth noticing then that in an exam question you might be presented with all of the information that we've had in lecture example 1, but you only need to derive a total for one of the departments, in which case you would just do that particular department. There'd be no need to do the entire working. Also in questions, the overheads that are needed to be apportioned will be done on some fair basis. You make sure then that you decide what's the most appropriate basis in. Step 2 involves us reapportioning the service cost centre overheads into the production centres. Remember, the production centres are the ones which the cost units, i.e. the items we're trying to work out a cost for, actually flow. And the service centres then are the support functions. So what we've got then is a product flowing through the production departments and going into finished goods. So what we need to do then is find a way of getting the stores and the canteen costs into the cost of the finished good, which ends up in the finished goods store. So we're going to end up transferring the service centre overheads out to the production centres so that we can share them out in the final stage between all of the products. This reapportionment is slightly more complicated if we've got more than one service centre and they do work for one another. For example, the store staff eat in the canteen. We've got 3 different methods then for reapportioning overheads depending on the scenario. The direct method, step-down method, and the reciprocal method. And as you go across this diagram, they get increasingly complicated. So you can see then in the direct method, inter-service departmental work is ignored, or there isn't any. In the step-down method, some is recognised, and in the reciprocal method, all of the inter-service departmental work is recognised. So what we need to do now then is go through each of the different techniques, because they do end up with different answers because of the assumptions which have been made. So with the direct method, we ignore it, and the service centre overheads only get apportioned once to production cost centres. It's a simple, however slightly inaccurate method, which is fine if there is only one service centre or they don't do work for one another. The step-down method also provides an approximation, but we are taking into consideration some of the inter-service departmental work, so it's slightly more accurate. It's best used then if some service centres provide support to others, but it's not reciprocated. So for example, here when the maintenance employees eat in the canteen, but the kitchen equipment isn't serviced by the maintenance department. So what we would do here is we would reapportion the canteen cost to the maintenance department and then apportion maintenance to the production departments. If both of the service departments are doing work for one another, we would reapportion the one that does the most, the service centres first. The most complicated and the most accurate method is the reciprocal or repeated distribution method. All interdepartmental service work is recognised, but it's more time consuming to use. If the examiner wants it, he stated in an article that he would ask the method that fully reflects the reciprocal services involved. So if he doesn't state that, then you're happy you can use the step-down method. And there are 2 ways of carrying out the reciprocal method: repeated distribution or continuous apportionment, or the algebraic method, which is probably a more efficient use of your time in the exam if you're confident with the use of algebra. Following on from our calculations in lecture example 2, we ended up with allocated and apportioned overheads in the 4 departments of Mars. What we've got now then is some estimates of the work done by the service centres for the other departments. So you can see here then that the stores department services the canteen, and the canteen services the store's employees. What we have to do then is we have to reapportion the service departments to the production departments using the 4 different methods, and we'll see how that's going to work. So we're starting off then with the direct method. In the exam, you wouldn't have to do the allocation and apportionment and then the reapportionment in one question that had as much complexity as this one, but it's important to illustrate all of the steps. So with the direct method, first of all then, we're going to assume that the stores and the canteen don't do any work for one another, or we can ignore it. So it doesn't matter which one we do first. So I'm going to start off by reapportioning the stores department. So I've got 90,800 to take out of the stores department. And I'm not going to split it 50-50. I'm going to split it based on the amount of work that's done that the stores department does for the other departments. So 5/8 of the store department work is for the mixing department, so I will allocate 5/8 of the stores overheads to it. So 5/8 then, or 62.5% of the store's work is done for the mixing department if we ignore the work done for the canteen. So that's 56,750, and 3/8 for the stirring department means that that's going to be 34,050. Next then I need to apportion the canteen costs. Again, I'm going to ignore the stores, and I'm going to do it on the basis of the work done. So 45 for the mixing and 40 for the stirring. So 45 out of 80, just over half, is going to go to the mixing department. So to the nearest dollar, that's 12,494, and to the stirring department, 11,106. So I end up with nothing in my service departments, which is the objective of the exercise, and 177,444 for mixing, and 84,556 for stirring. In part B then, we're going to use the step-down method, where we're going to recognise some of the interdepartmental service work. Because the stores department has the biggest amount of overhead in, we're going to start with reapportioning the service centre that is the stores. And we're going to reapportion the stores then in the proportions 50% to mixing, 30% to stirring, and 20% to canteen. So when we were using the direct method, we ignored the fact that the stores were doing work for the canteen. So what we've got now then is 45,400 in mixing, 27,240 in stirring, and we're actually going to increase the overhead in the canteen by 18,160. So we've now got 41,760 in the canteen. And we're going to reapportion the canteen overheads of 41,760 between the production departments. So we're recognising some of the interdepartmental service work, but not all of it. So we're ignoring the fact that the canteen does work for the stores in this particular method, and we'll see how to deal with that shortly. So 45 out of 85 will go to mixing, and the balance of the canteen will be allocated to stirring. So we're going to end up with 175,708 in the mixing department and 86,292 in the stirring department. And as before, we've got nothing in either of the two service departments, because remember, our objective is to get the overheads into the departments through which units actually flow, so the production departments. When it comes to using the reciprocal method, there are two approaches that we can use. And in C, we're going to see the repeated distribution, and D, the algebraic method. When you have a look at the C, then you can see we've completed it for you as a worked example, because it's actually just a lot of the same calculations. So rather than ignoring or just prioritising the biggest service centre, what we do here is we start off by reapportioning the stores because it's the biggest service centre, but we reapportion it not just to mixing and stirring, but also we're going to put 20% of it into the canteen. So what that effectively does is increase the value of overheads in the canteen. So we might have nothing in stores now, but we've got even more in the canteen, which needs to be shared out. So we're going to share that out, 45% to the mixing, 40% to the stirring, but we're also going to put 15% into stores. So now we've got an amount in the stores department, and we have to go through the process all over again and reapportion the stores 50, 30, 20%. And what you'll notice is that each time you do this, the numbers that get left in your service centres are smaller and smaller. And the idea is that you keep going until you end up with no overheads left in the stores department and no overheads left in the canteen. Don't worry about working to the nearest cent or anything like that. This is just an approximation, so you can always round up in favour of the production departments. So we've got 176,203 in the stirring and 85,797 in the stirring department. The final method that we'll see, the algebraic method, is another way of doing the reciprocal calculation, and once we've completed it we would hope to get the same numbers as we did in part C. Whether you choose to use repeated distribution or the algebraic method is entirely up to you in the exam, whichever one you feel more confident with. It's just the algebraic method is a bit quicker if you feel confident with it. So what we're going to do is let S equal the total amount to be transferred or reapportioned out of stores, and we'll let C be the amount to be transferred out of the canteen. So S is equal to 90,800 because that's how much we allocated and apportioned in step 1 to the stores, plus 15% of the value of the canteen. And the canteen had 23,600 allocated and apportioned to it. We've also got 20% of the stores costs because the stores do 20% of their work for the canteen. So what we've got now then are two simultaneous equations, and we need to solve those. The easiest way to do that is to pop one of the equations into the other. So S is equal to 90,800 plus 15% of C, and C was 23,600 plus 0.2 S. So if we expand out the brackets, 0.15 multiplied by 23,600 is 3,540, and so S then is going to equal 90,800 plus 15% of C, and C is 23,600 plus 0.2 S. So what we have to do now then is expand out the brackets, and to do that you need to multiply everything inside the brackets by 15% or 0.15. So 0.15 multiplied by 23,600 is 3,540, And 0.15 times by 0.2 gives us 0.03s. And we add that to the 90,800. What we've got now then is S's on both sides, so we need to regroup those together. And the best way to do that is to deduct 0.03s from both sides. So S minus 0.03s is equal to 90,800 plus 35,400. So 0.97s is equal to 94,340. To get S on its own, divide both sides by 0.97 and you end up with S equal to 97,258. And that's going to be the total amount that will get transferred out of the stores department. We need a value for C, so we can substitute that value for S into C. And so we've got $97,258 is equal to 90,800 plus 0.15c. 0.15c is therefore equal to 97,258 minus 90,800. So C is equal to 6,458 divided by 0.15. So C is equal to 43,053 to the nearest dollar. When you're going through then you might be able to solve these equations with fewer steps than I've done, but what I've tried to do is to show you lots of the steps in case you're not that confident with the rearrangement of the formulas. With the algebraic method we're not quite done now, because what we need to do is we need to actually allocate that amount between the production departments. So we need to set up a table similar to the ones we've been using. So what we're going to do then is we're going to allocate out the stores costs in the proportion 40, 30, 20, but instead of allocating the 90,800, I'm going to allocate out the total that gets allocated from stores in one go. So 50% then to the mixing department and 30% to the stirring department. Then for the canteen, we're going to allocate out 43,053. And for the canteen, that's going to be in the split 45, 40, 15. So 45% will go to mixing and 40% will go to the stirring department, and the final 15% going into stores. So as before, we end up with nothing in either of our service departments, but we end up with $176,203 in mixing and $85,797 in the stirring department. And remember, that's the same solution as C, because they're just different ways of getting to the same answer. And it's entirely up to you which method you prefer. The two will always give you the same answer. But generally speaking, in exam questions, you'll get away with using the direct method or the step-down method, depending on the level of reciprocation of the service departments. So in the previous two examples, we've worked through all of the steps. Lecture example 3 is much more typical of an exam standard question, so it's a good chance for us to practice what we've seen already. Because a company has got 2 production cost centres, A and B, and 2 service centres. And we're given some information, and what we want to know is how much would A's total overhead costs be if the company used the step-down method to reapportion service cost centre overheads. Remember, with the step-down method, there's some recognition of the work that service departments do for one another, and we need to start off with that as a basis. So what you can see here then is that D uses C, but C does not use D. So we'll start off then by reapportioning C into D, and we'll use the same sort of table format as we've been using previously. So first of all then, what we're going to do is look at the use of C. So we've got $8,000 in C, and we're going to split that out in the ratio 60% to A, 30% to B, and 10% to D. So we're going to have 4,800 in A, 2,400 in B, and 800 in D. Now, strictly speaking, you don't really need to worry about B here because it's not going to impact on our answer. So we've now got 10,800 in D, and we need to reapportion D between A and B. So 80% of it is going to go to A. So 80% will be 8,640. So the total amount in Department A is going to be $25,440, which was answer D. The final step then involves absorbing the overheads into the production. So what we've got then is we now have a total amount of overhead in each of the production cost centres. And what we're going to do is divide those by the activity level to give us an overhead absorption rate. And this is a very, very important formula for management accounting. So we know how to get our production overhead because we've followed step 1 and step 2 in order to do that. In order to complete step 3, we have to choose the activity. And ideally then we want to choose one which reflects the way in which the overheads are being incurred. The main ones that you'll see in the exam are per unit, if the company produces products which are very, very similar, or if it's only producing one product, or if it's a labour-intensive production process, you could use labour hours, or machine-intensive, you could use machine hours. Sometimes you might see an approach then which is a percentage of direct labour or materials or of the total prime cost. Whichever basis for activity is chosen, the process of absorbing it into the individual units is the same. If we use any basis other than units, we have an extra calculation to get the cost per unit. So what we do then is we calculate the overhead absorption rate, for example here using machine hours. What we then end up with is a rate to absorb overheads per machine hour, and then we need to multiply that by the machine hours per unit to give us the amount of fixed overheads per product. And this has to be repeated for all of the production cost centres, and if necessary, the company can use a different basis of absorption for each of the departments, the production departments. And at this point, it seems worth going back to the diagram in section 2, where we have taken our total indirect overheads And in the first step, we have allocated and apportioned them to all of the different cost centres. Then we've reapportioned our service centre overheads into the production departments so that we can absorb our fixed overheads into individual units based on a given level of activity. And if we work out an overhead absorption rate per labour or machine hour, we need to multiply the number of labour hours or machine hours per unit to give us that overhead per unit for each of the departments. Step 3 then is going to be demonstrated here in lecture example 4 Mars. So we've used the direct method to reapportion service centre costs to the production departments. And what we're going to do now then is we're going to actually work out how to get those overheads of 177,444 and 84,556, which we calculated in example 2b, into an individual batch of units. So we're given some information about the two different departments, and firstly we're asked to decide which basis is most appropriate for each of the departments. So in department that's responsible for mixing, we have to decide what would be the best way to absorb the overheads. Well, we can see that the number of machine hours compared to the number of labour hours is significantly lower. So given that there are mostly labour hours involved in the mixing department, it seems that mixing is a very labour intensive process. So labour hours is going to be the best way for apportioning and absorbing our overheads. In the stirring department, however, it's the machine hours that's much higher, so it's a machine intensive department, and therefore it makes sense to absorb the overheads on the basis of machine hours. So for the mixing department, we're going to do it per labour hour. And for the stirring department, we're going to do it per machine hour. So what we need to do then is to calculate an overhead absorption rate, first of all, for each of these bases. So the overhead absorption rate per labour hour is going to be 177,444 divided by the 12,500 labour hours. So we end up with a rate of $14.20 per labour hour. Now the number of batches being produced in the period is 2,500. So that means that it takes 5 hours per batch. So therefore the appropriate amount of overheads in the mixing department will be 5 hours times by 1420. Which is $70.98 per batch. For the stirring department, we're going to do the same thing, but instead of basing it on labour hours, we're going to base it on machine hours. So we've got 84,556 of overheads, and we've got 10,000 hours. So that gives us a rate of $8.46 per machine hour. And each one is going to take 4 machine hours. We've got 10,000 hours and 2,500 batches. So we're looking at overheads of $33.82 per batch for the mixing department. So that's total overheads then of $104.80 per batch of Mars bars.
Section 6 looks at under and overhead absorption of overheads. Now, an under or absorption of overheads will occur because the predetermined overhead absorption rates that we set at the start of the period will always be based on estimates. When we get to the period end, we'll need to look at the difference between our estimated costs and our actual costs to work out whether we have over or under absorbed our overheads during the period. If we've over-absorbed our overheads, it means that the overheads that we've charged to cost of sales, so in other words, those based on that predetermined overhead absorption rate, are greater than the overheads actually incurred. So therefore we've charged too much. We've over-absorbed within cost of sales. If there's an under-absorption of our overheads, it means that insufficient overheads have been charged to cost of sales. So in other words, our actual overheads incurred are higher, but we haven't charged enough to cost of sales. As we said, there's always likely to be a difference between those rates that we estimated at the start of the period and the actual costs incurred for that period. So therefore, a calculation requiring the under or over absorption of overheads is normally required at a period end. You could also be asked to do this in the exam, and what we would do is apply this pro forma where we will compare our actual overheads incurred, so in other words our actual costs, to the overheads that we absorbed to cost of sales. So in other words, our overhead absorption rate based on our estimates, multiplied however by our actual units. That will give us an under or over absorption of overheads as we discussed above. Let's put it into practice then in lecture example 5. Lecture example 5 is an exam standard multiple choice question worth 2 marks. If we read the requirement firstly, it asks us by how much was the total overhead either under or over absorbed for the period. Remember, what we want to do here is we want to compare our actual overhead incurred compared to our overhead absorbed, which will be based on our overhead absorption rate multiplied by our actual units. Let's read through the scenario. A company uses an overhead absorption rate of $2.50 per machine hour, so we do need that information to work out our overhead absorbed. That was based on 32,000 budgeted machine hours for the period. And during the same period, the actual total overhead expenditure, so in other words our actual costs, were 78,875, and our actual number of hours were 30,000. So when we look at calculating our overhead absorbed, it will be based on our actual hours multiplied by our overhead absorption rate. Therefore, we do not need the 32,000 budgeted machine hours. Okay, let's do the calculation together. So we've seen that our actual costs, our actual expenditure was 78,875. What we've absorbed is based on our overhead absorption rate of $2.50 multiplied by our actual machine hours of 30,000. That's what we would have absorbed, that's what we've charged to cost of sales. So therefore we've absorbed 75,000. Our actual costs are greater, so therefore we haven't absorbed enough. In other words, we have under absorbed, and the amount that we have under absorbed is 3875. 3875 under absorbed, and therefore the correct answer is D.
With absorption costing, we were looking at the full cost of making a unit. But in the introduction, I said that we had an alternative, which was marginal costing. And for some businesses, it's appropriate to just know the variable costs of the units that are being produced, because the fixed costs, for example, rent and rates, are actually period costs. So if a business opts to make more units, then the rent cost isn't going to rise in the short term because it will be fixed for a given level of capacity. So under marginal costing, we just consider the variable costs of a product or service. And these are the things then that would be avoided if we didn't produce the product. So under marginal costing, we just take the direct materials, labour and overheads to give us the marginal production cost. And that's what we use to value inventory under marginal costing. So it doesn't go as far as absorption costing, but we have popped that here just to show you the extra step. Now, we said when we were introducing the idea of absorption costing that working out the direct materials, labour and overheads were the easy steps. And actually, after the complicated steps in absorption costing, I'm sure you'll be delighted to know that marginal costing is relatively much more straightforward because it should be fairly easy to work out what the extra cost of producing one more unit is, the marginal cost. So we know now how to work out the full cost under absorption costing using our three-step approach, and we know how to do it under marginal costing because it's just the direct costs. So we now need to think about calculating a profit or a loss under both of these techniques. What you'll see here then in 6.1 is the pro forma for a marginal costing profit and loss statement. And the big thing to note here is that inventory is valued at the variable production costs, so the cost of producing one extra unit. So if we just run through our pro forma, we start off with sales, then we've got our cost of sales, but that cost of sales that just includes variable production costs and inventory at variable production cost. Then we take off the selling and distribution costs, which are variable. Instead of being based on the number of units produced, though, these will be based on the number of units sold. So we're going to have sales less all of the variable costs gives us contribution. And contribution is a very important term in management accounting that we'll be covering more shortly. Then we take off all of our fixed costs. So those are our production fixed costs, things like the rent and rates of the factory, but they're also all of our fixed costs because we have a business, so selling and distribution or administration, and they get us down to our net profit. So good time then is manufacturing watches, which it sells for $25, and we've got some information about the production costs. So the direct production costs are $20 per unit, and we have a variable selling cost, perhaps a box or something to put it in, of 50 cents per unit. Given some information then about what we expect and what we actually make and sell in 2 years, as well as the actual fixed overheads for production and selling. We don't have any opening inventory, and what we have to do is to work out what the profit and loss is going to be under marginal costing for both of the 2 years. And over the page you'll see that we've got the pro forma profit and loss account to complete. So what we're going to do is to complete those now for both years. So I'm going to start off with year 1, and I'm going to start off with the sales figure of $25 per unit multiplied by the actual sales of 13,000. That's $325,000 in year 1. There was no opening inventory. My variable production costs then are not based on the units sold, they're based on the units made. And they were $20 per unit, and we made 14,000. So that's 280,000. Now we made 14,000, but we only sold 13,000. So we have 1,000 units of closing inventory and they will be valued at the variable production costs of $20. So closing inventory is worth $20,000. So what that means then is that we have a cost of goods sold of $260,000. We need to take that away from the sales, and that's going to give us $65,000. But before we get down to the contribution figure, we need to take off the variable selling costs. And these are based on the number of units sold, which in this case was 13,000, and they were 50 cents each. So that's $6,500 of variable selling costs. So my contribution is $58,500. And then we can take off the fixed costs, which will be the actual fixed costs. For production, they were 11,000, and for selling, they were 5,000. So that's going to be another 16,000 to come off, which gives net profit of $42,500. Having completed year 1, we now need to do the same for year 2. To make it a bit easier, I'm just going to change the colour of my pen so that you can see which year my workings relate to. So the sales were $25 per unit, but in year 2 we were going to be selling 12,500. So sales were 312,500. There was no opening stock in year 1, but year 1's closing stock becomes year 1's opening stock. Production in year 2 is still $20 per unit, but in year 2 we only made 11,500 units. So our production costs were $230,000. Now we need to think about inventory levels. We had 1,000 and we made 11,500. That's 12,500, and that's exactly equal to the number that we sold, so there's no closing inventory. So that means the cost of goods sold in year 2 is $250,000, giving us $62,500 when we take sales less cost of goods sold. Variable selling costs, remember, based on the number of units sold, 12,500 times by 0.5, so that's going to be 6,250. So contribution in year 2 was 56,250, and my fixed costs in year 2, same as year 1, so another 16,000 to come off before we get down to profit of 40,250. Now don't worry if you think that that seems like a lot of work for 2 marks, because there is a shortcut which we will explore in a moment, but it's just worth understanding how the profit and loss fits together under marginal costing. So let's explore this idea of contribution a little bit further, because it's a fundamental concept in marginal costing. What we mean when we're talking about contribution is actually contribution towards fixed costs and profit. Because when we sell a unit, what we're doing is we're taking our sales less our variable costs, and that's making a contribution towards our fixed cost. And once those fixed costs are covered, we will then start to make a profit. So the definition of contribution then is selling price less all of your variable costs, and that includes non-production variable costs. So for example, in selling and distribution expenses. It only takes account then of variable costs. An important technicality then is that inventory is valued at the marginal cost of production, whereas contribution also takes into consideration any selling costs. So in the previous example that we've just done, we could have worked out a contribution per unit and then multiplied that by the number of units to give us our total contribution, from which we could deduct the fixed costs to get to the profit. So the selling price then was $25, the variable costs were 20 for production and 50 cents for selling. So my contribution per unit was $4.50, and in year one we sold 13,000 units, which gives us a contribution of 58,500, and then I could take off my fixed costs of 16,000, and that would give me net profit of 42,500, which you should remember is the same as the net profit we worked out by doing the statement. In example 6, we're going to have a chance to put that shortcut into practice. We're given some information then for Parsons about its budgeted production of product E's, which are 5,000 units per month. And we're given some information then about how many units we are going to have in stock at the start and the end of the month, as well as information about the actual product and the fixed costs. So what we want to do then is to work out what our budgeted profit will be for next month using marginal costing. So we need to start off by working out the contribution per unit. So the sales price less the variable costs will give us our contribution per unit. So my contribution per unit is $10.50. Now we need to look at how many units we sold. Well, we start off then with 400 and we made 5,000, but we're going to have 900 in stock at the end of the year. So that means in the month we must have sold 4,500. So our total contribution is 4,500 units times by $10.50. So contribution is going to be 47,250. To get to profit, we take off the fixed costs of 29,500, and that gives us profit of 17,750. Watch out for questions, because sometimes they'll ask for budgeted profit and sometimes they'll ask for budgeted contribution. So what are the advantages then and disadvantages of marginal costing? Well, probably at this point you're thinking that the major advantage of marginal costing is that it is much easier, and that's because instead of working out an absorption rate, we treat our fixed overheads in accordance with their nature. So we treat them as period costs and take them off in their entirety. Advocates of marginal costing then say that the rent isn't related to the number of units, so actually it's not worth going through all of those steps to try and split it out. It's also very useful for decision making, because if you have spare capacity or you're looking at making a short-term decision, you just need to cover your variable costs, because in the short term we'd be unable to change our fixed costs, and so they shouldn't influence the decision. It also means that profits depend on sales and efficiency, not production levels. So you're not able to carry forward fixed overheads in closing inventory. The disadvantages, though, is that if we sell products at a marginal contribution on an ongoing basis, we'll fail to cover the fixed costs, which means that the company won't be profitable. It also doesn't comply with IAS 2, whereby the value of closing inventory must include production overheads incurred in producing those products to try and match the cost of production with when the sales occur. It also means that we have to split mixed costs into fixed and variable elements. That last one shouldn't be too much of a problem because remember we can use the high-low method to do that. Having considered the profit and loss under marginal costing, we're now going to consider it under absorption costing. And what we have here then is the pro forma layout for the absorption costing P&L. So we start off with sales and cost of sales. But what you'll notice is that in cost of sales, we have fixed overheads absorbed plus an adjustment for under or over absorbed fixed overheads before taking off our closing inventory. And that closing inventory is valued at full production cost, whereas under marginal costing, it was only valued at the marginal production cost. Instead of contribution, we're then going to work out gross profit and then take off all of the non-production costs, so the fixed and variable selling and admin, to get down to the net profit. So the cost cards are different under absorption costing and marginal costing because of this idea of calculating contribution under marginal costing and working out the full production cost under absorption costing. So the cost card under absorption costing includes fixed overheads, and under marginal costing it excludes the fixed overheads. And so the profit figures were different and we need to look at reconciling them. The fact that the absorption costing cost card included them and the marginal costing excluded fixed overheads suggests that we're going to be using fixed overheads to help us explain the difference. We also need to make sure that we're happy with the differences between and the advantages and disadvantages of absorption costing, because remember we've already covered the advantages and disadvantages of marginal costing. In worked example 3, if we take the profits for each of the 2 years under absorption costing and marginal costing, we can see that the total profits are the same. However, the split between year 1 and year 2 is different, and the reason for the difference is because of the value of closing inventory. We end up with an additional amount of fixed overheads carried forward in year 1's closing inventory under absorption costing of 90 cents because we're valuing that closing inventory of 1,000 units at $20.90 rather than $20. In year 2, we end up with the marginal costing profit being higher because we are bringing forward less in opening inventory. And we can use this knowledge to help us reconcile the profits. Reconciling profits then is an important skill for the exam because it is a way of the examiner testing that you know the differences between absorption costing and marginal costing without you having to do lots of different calculations. So the difference in profit is the changing inventory in units multiplied by the overhead absorption rate per unit. So in our previous example, we had 1,000 units difference and the overhead absorption rate was 90 cents per unit. So we ended up with a difference of 900. As you can see from the reconciliation above though, it's not always easy to tell whether the absorption costing profit or the marginal costing profit will be higher. It depends what is actually happening to inventory levels. You need to find a way of remembering the difference, and one such way is that when production is greater than sales, closing inventory is bigger than opening, absorption costing profit will be higher than the marginal costing profit. And that works alphabetically because P comes before S, C comes before O, and A comes before M. And if you reverse the signs, then the same is true. And if production is equal to sales, closing inventory is equal to opening inventory, and absorption costing profit is equal to marginal costing profit. However you remember it, you need to find a way of remembering that when stocks are increasing, absorption costing profit is more, and when stocks are decreasing, marginal costing profit is greater. So the difference then in profits in lecture example 7 is going to be important because we're given the absorption costing profit of 90,000 and we have to work out what the profit would be using marginal costing. So the difference then is equal to the overhead absorption rate per unit times by the change in the level of inventory. Well, we produced 35,000 units and sold 30,000, so the change in inventory is 5,000, but we need to work out the overhead absorption rate per unit. The overhead absorption rate per unit is equal to the budgeted fixed production costs divided by the budgeted activity. So we're only concerned with the budgeted fixed production costs. So 157,500 divided by 35,000 gives us an overhead absorption rate of $4.50. So step 1 then we've completed, which is to work out the difference in profits, is 22,500. What we have to decide now then is whether marginal costing profit or absorption costing profit will be higher. So here production is 35,000 and sales are 30,000. So production is 35, which is greater than sales of 30. So that means that closing inventory is going to be higher than opening inventory, which means that absorption costing profit will be higher than marginal costing profit. So the marginal costing profit will be 90,000 minus 22,500, the difference in inventory. That's 67,500. So the advantages then of absorption costing and marginal costing are summarised here together. First of all, let's take absorption costing. It recognises that your selling price has got to cover all of your costs. So you can't just cover the materials and labour and other direct expenses in the short term. You need to also in the long term cover your fixed overheads. It also complies with IAS 2 for inventory valuations. The problems with absorption costing are that potentially profits could be manipulated by changing production levels. So you could increase your profits in a period by increasing your closing inventory because then you would carry forward more fixed overheads. It also assumes that overheads are volume related, and in reality, although they might be in some way volume related, if production wasn't very high, you wouldn't need a very big factory. In reality, they're not directly related. The advantages and disadvantages of marginal costing are really the opposite. It highlights contribution, so it is useful for decision making, because when you're making a short-term decision, you just need to consider the marginal production costs. We treat fixed overheads for what they are, period costs, and our profit depends on sales and efficiency rather than production levels. But there's a problem that we might not cover the fixed costs. We need to do an adjustment for the stat accounts, and we need to analyse our costs into their mixed costs into their fixed and variable elements. Now that we understand the principles of absorption costing and marginal costing, we need to turn our attention to how this could be tested. An exam question might give us information and ask us to work backwards. So for example, we might be given the change in stock and the different levels of profits, and have to work backwards to calculate the overhead absorption rate. This is the case in worked example 4, where we start off with opening inventory of 12,600 and end up with closing inventory of 14,100. So our inventory level has increased by 1,500. We're also given the profit under marginal costing and absorption costing, and the difference in profits is 9,750. What we have to work out here then is what the fixed overhead absorption rate per unit is. We're going to use this formula. The difference in profit is equal to the change in stock in units times by the overhead absorption rate per unit. So the overhead absorption rate here is equal to 9,750 divided by 1,500. So it's $6.50 per unit. Lecture example 8 then is a very typical exam question because we're trying to work out our overhead absorption rate per unit. So it's a chance for us to practice what we saw in the previous worked example. So the change in inventory is 1,000 units, 10,000 compared to 11,000, and the change in profits is $5,000. So the overhead absorption rate per unit is 5,000 divided by 1,000. So that's $5 per unit. Now let's have a look at the multiple choice answers here. The correct answer is obviously B. However, the other answers that the examiner would have provided would not have been randomly generated. One of the classic downfalls in multiple choice questions is stopping too early. So if we worked out 5,000 and stopped before we'd done the final step, then we would have selected answer D. If you'd been having a silly moment and got your formula the wrong way up, so done 1,000 divided by 5,000, you could have got answer A. So it's worth bearing in mind that just because you get an answer that is listed doesn't necessarily mean that it's going to be correct. You need to ideally work through your calculations and only look at the options once you're satisfied that you've done all of the necessary steps. During this chapter, Accounting for Overheads, we've covered a lot of material that's very important to management accounting and will be the feature of several questions in section A of your exam. It would also be useful in further ACCA studies. You need to make sure then you're happy with all of the concepts, and the overheads, remember, as a beginning point, are the costs that we incur as a result of making the product that can't be directly linked to one unit. So these indirect costs. First of all, we looked at absorption costing, and with absorption costing, we want to work out the total cost of the product, including an element of overheads. So we go through our three-step approach. So we allocate overheads which are directly attributable to one cost centre, and we apportion the other overheads between the cost centres. Step 2 then is to reapportion the service centres and transfer all of the service centre overheads into the production centres. And we saw that there were 3 methods for doing this: the direct method, the step-down method, and the repeated distribution, which can either be done using repeated calculations or algebraic methods, both of which make the reciprocal method. Final step then is absorption, so to work out the overhead absorption rate. So the budgeted fixed overheads divided by the budgeted level of activity. We then moved on to look at a simpler alternative, which was marginal costing. With marginal costing then, we're just looking at the variable production cost of one unit. And then we worked out contribution, which is selling price less all of the variable costs. And that gives us the contribution towards fixed costs and then profits. Under marginal costing, we treat our fixed overheads as period costs and take them off the total contribution to give us profit. Under absorption costing, the fixed overheads are absorbed into the units of production, and fixed overheads are also carried forward in closing inventory, because that closing inventory will be valued at the full production cost. Absorption costing recognises that we need to cover fixed costs in the long run, but marginal costing is better for short-term decisions. We need to be able to reconcile the profits because they're going to be different depending on whether we use absorption costing or marginal costing. And the difference is the change in inventory multiplied by the overhead absorption rate.